what we'll do is that, we will look at the key financial terms that one should know when you're looking at your own business for the next 40 to 45 minutes. And then in the last 15 minutes, we will look at Q&A from the participants. What we can also do is that during the session, if you have a question, you can either write it, in the questions box that you see, or you could actually click on a tab which has a hand in the attendee list, and then we will unmute you so that you can ask the question. But basically, it's better if you can just keep your questions together for the end so that we can have a more focused discussion. So just to give you a tone of how I'm going to look at it, I'm going to assume that you do not have too much of a background in finance, and a lot of terms that you see might be the first time that you look at it. If there are some that you feel you already know about it, that's fine. We will look at it in little less detail than earlier. So I just said, the format and the agenda is that we're going to look at key concepts and financial terms for about 45 minutes, and then look at the Q&A for the next 15 minutes. So what the slide that you see on the screen basically says, what are the key questions that you need to answer or ask yourself before you're starting off your venture, right? So one is to say, I have an idea. And the second is to say, what are the financials around it? And if you're trying to build your business plan, what are the key questions that you need to ask yourself? So some of the key things are saying, where is the revenue going to come from? How many people am I going to target? What is the price that I'm going to set for? At the end of the year, how much money do I think this business is going to make? More important than revenue when you start up really is, how much is the cost that I need to put together for setting up this business? So, what you need to be aware of is that in the beginning, what is definitive are the costs. The revenue might or might not come at the same pace that you had planned for, but definitely there will be some costs that one needs to be aware of. So the third point that is there is saying, what is profit? Basically, profit is how much money am I making minus how much cost am I incurring. So how much is left for me or for the business, which is the profit. A related point to that is to saying, what is the break-even point? What that means is that how long is it going to take for me to reach a point where there is no profit and there is no loss? So I'm not having to put in any money, but I'm not even making it. So it's easier for you to start targeting saying, when is the break-even point? So that you know how much money needs to be put in, rather than saying, when is it that I'm going to make a profit? A related point to this is saying, how much cash do I require? So like I just mentioned some time back, when you say, these are my costs, now till a certain point, what will happen is that you would not be making money, but you will still need to keep pumping in money into your business to ensure it is floating, and also that it can reach a point where it starts making money. So how much cash do you require to start and to run the business? Related, how much is the capital do I require? So initially, day one, how much money do I need to put out? Right? Last but not least, how do I get the financing? So am I looking at putting all the money myself? Am I asking friends and family? Am I saying that I'm going to go out and look for investors? What we do is that we'll start looking at key concepts and each one of them in a little bit of detail. So the first one that I mentioned some time back is, what is the revenue? What is the revenue for my business? Now, revenue basically is a function of two things. One is, what is the price of each thing that I'm selling? So it could be a software program, it could be it could be a garment, it could be a bag, it could be a service. When all of that is there, what is the price for each such unit of the commodity or the service that I'm selling? That multiplied by how many of these will I sell? So basically, if I just go a little ahead and say, what is the sales? So what is my sales for the business? So like you can see on your screen right now, it says, if I'm going to sell 100 pieces of 500 each, I'm going to make 50,000 rupees. Alright? So that is the amount that you need to be able to figure out when you start out your business. The second thing, and this is what we go into little more detail because I think that's one of the that's the critical part of the whole thing is, what are my costs, right? So what you see on the discussion term column is that costs, it's not just one homogeneous number. So it's not just saying my costs are these. You will be able to break it down and saying what are the different types of costs that one looks at. So, the one that you see first, it says fixed costs. So what are fixed costs? So let's just go down to what are fixed costs. Yeah. So what are fixed costs and what are variable costs? Now fixed costs are those costs that you will be incurring irrespective of whether you make a single sale of unit or not. So for example, if you're going to say I'm going to start my business and I'm going to rent a premise. Now you have to pay the rent month on month whether or not you are going to sell anything, right? Am I going to hire people? So if you hire people, you have to pay them their salary month on month whether or not you're making any sale, right? If you're going to set up a website, so that website is already set up whether or not you're going to make any sale. So that is a fixed cost. So you will need to be very clear on saying how much am I going to incur in a fixed cost, which is irrespective of any sale being made. Now, compared to fixed cost is the concept of a variable cost. So what is a variable cost? A variable cost is incurred every time you make a sale, right? So for example, if you're going to say that I'm going to, sell a bag. So if you're going to buy the bag from somebody, the amount that you pay to buy each bag, if you're going to pack it, the amount that you spend packing of each of them, if you're going to courier it or ship it to somebody, the amount that you're going to spend to ship the bag. So these are costs that depend on per unit of sales. So what happens is that variable costs will continue increasing as you increase the units being sold. So if you realize that for the three components that I just mentioned for say a bag, say the raw material, the packing and the courier, for each such bag is say 50 rupees. And if you find that I'm not selling one bag but I'm selling 100 bags, so the variable cost for you becomes 15 rupees. So these are the two concepts. So what you also see below is manpower cost a fixed or a variable? So what happens is that why we put that question over there is saying that if, for example, you say that my manpower is fixed plus bonus, we pay them for every sale that they make. So then it becomes fixed as a salary and variable for every. So now let's look at, after we've discussed variable costs, the other two costs that I want to talk about are controllable costs and uncontrollable costs. So what is the difference between a controllable and an uncontrollable cost? A controllable cost is that cost which you can decide on. Let me just go back to my say. Controllable costs are those that you can decide to reduce by taking different decisions. For example, rent is a typical controllable cost that you can look at. So, you can say I'm not going to be located in an expensive location, but I'm going to be further away from the city. Or I'm not going to be in the key business district, but I'm going to be a little away. Salary, you can say that I'm not going to hire 4 people, but I'm going to hire just 2 people. Opposed to that, an uncontrollable cost is that cost which you do not have too much of say on. So things like if you are working in a certain industry, the margins that are to be paid to the dealer will be the same for you as well as any other competitor that is there. So basically uncontrollable costs are those which you will have to incur and also which tend to be the same for almost everybody in the business that you're in, or it's it's an industry-wide cost. Now the other two types, the other two distinctions that you need to look at on cost is what is an expenditure versus what is an expense. An expenditure is a cost that you incur upfront or in a certain year, but which will give you benefit for more than 1 year. So it's an asset that you create for yourself in the business. So for example, like, the things that you see here is like a car. So if you buy a car, you might buy it in year 1, but you will continue to have that car for 5 years. A website, you develop the website. Now, we're not talking of upgradation on the website, but the basic website that you create will tend to remain with you for the next 3 or 4 years. So you get a benefit out of it for more than 1 year. Compared to that, expenses are incurred every year and they do not give benefit beyond that. So they do not hence even create an asset for you. So for example, rent. Now you give rent every month and you can only use that premise for that month that you give the rent for. Similarly for salary. Right now, why we have put this here is that you need to be aware that you do not put the expenditure that you make for your business upfront into your profit and loss. So you do not say that, oh, I bought a car for 10 lakh rupees for this year, so my profit for this year will be minus 10 lakhs. It doesn't work like that. What you will have to say is, if my car is going to last for me for 5 years, I have to use this for 5 years, so my cost for the car for this year is 2 lakhs. Okay. So, like we just spoke of, we say, what is the revenue, what are the costs, and hence, what is my profit? So what you see on your screen right now is to say, what are my sales minus what is my variable cost, which is also known as cost of sales in the industry parlance. So how much money am I making by selling a certain good minus how much do I need to incur as costs just to make that sale? What is the cost that is directly attributed to that particular sale, right? That gives you gross profit. Then once you subtract, say, at that immediate point you don't have cash. But if at that point, for example, you need to pay salaries, you will require cash to be able to run that month through. So that part, when you have already made the sale but you have not received the money, is what you will need to be able to fund. So you will require working capital. A similar concept is of saying that if you are going to be in a business for, say, a couple of years, and then you realize the first year you're not making profits, you're actually going to make losses. So you will need to have the cash requirement for supporting your business when it is making losses. So, for all of you who are looking at saying, I'm going to start out, you will need to very critically look at these 3 buckets and say, do I have enough money for all these 3 buckets? Right? So just to go in a little more detail, what could be one-time startup costs for a business? So, fixed assets, of course, we put just 3, 4, and a lot of it, the first 2 could be related to, if you're looking at a manufacturing unit or you're looking at a trading unit. But overall things like furniture, laptops, cars, websites, those kind of things will come into your fixed assets. The second one is pre-operating. So these are the costs that you will have to incur before you start out. So, you're setting up your office or a telephone internet connection. If you're looking at setting up a company or a partnership, you will have to look at what are the incorporation expenses, what are the licenses that I need to buy. So for example, if you're looking at a software company, right, and you need to buy some licenses for that to be able to start. So that license, if you need to pay royalty fee to some people to be able to start your business. So these are the things that you will need to incur upfront even before the business starts. Now, I had spoken of revenue, I spoke of cost, I spoke of profit, right? And I even mentioned in the beginning that you will need to be able to ascertain of saying, when is it that the business will start making money? Now, even before you reach a point of saying, when is it that I'll make money, you will have to say, when is it that I am not going to incur a loss, right? So what you see here are, so the purple thing that you see below, that is the fixed cost, right? Now, visually, if you're being, being able to relate to what I just spoke some time back, fixed costs remain the same irrespective of how much you sell. Okay? The yellow line that you see is the variable cost that you incur for as you increase sales, your variable costs will increase. Please note that the variable costs don't start at zero. They start after the fixed cost has been incurred. Because your total cost, like we just mentioned some time back, is variable cost plus the fixed cost that you incur. Okay? The red line that you see is your sales line. And where the two lines meet is where is your break-even point. Because that is the point where the amount of money that you will make through your sales will be equal to your fixed plus variable cost. That is all the costs that you have incurred in the business. Okay, so just to give you an example on this one, if you look at the sales price per unit minus the cost price or the variable cost per unit. So if the sales price is 50, cost price is 30, the gross profit per unit that you make is 20. If the fixed cost at 2000, then you will have to look at selling 100 units to be able to cover the costs. You will have to notice here that when we calculate gross profit, we do it first on a per unit basis. So that's the best way to look at your business, to say how much am I going to, what is my sales price per unit, or how much am I going to make per unit, and then divide the directly attributable variable costs to that sale and say how much am I going to spend to make that unit or sell that unit. Get the gross profit and then start looking at saying, okay, what are my total fixed costs? How much am I going to incur? How much is the gross profit that I'm going to make on all the units that I sell to be able to arrive at the break-even. Okay. Now, I just mentioned some time back that there are expenditures that you make, which are also the assets that you create for your business. Okay. So now let's look at what are the assets of a business. So, I had just mentioned some time back saying when you make, when you spend money or when you incur costs for, assets which will last with you for a longer time, that is when you basically use a part of the funds that you put into the business, right? So the two classifications now, when you look at assets, that are very critical over here. One is called fixed assets. All right. So, the term fixed does not mean immovable. So it doesn't mean, it's not just a building, right? What fixed asset means is what is going to last with you for a longer time, right? So what is there for a longer period of time. So like you see over here, there are long term. Within that also you can look at a long term. So for example, if you have bought a factory, not rented, but if you bought a factory, if you have bought an office for yourself. The other way to look at it is that if you lease it out for a very long time, right? And basically buying is what we look at. Short term is, if you're buying smaller things like chairs, computers, other things like in a business, if you're looking at a warehouse, anything which is going to be there for a car, those are fixed assets in a longer term assets. The second one that you see is related to a point I had mentioned some time back on current assets, which means what are those things that you have with your business which is creating money for you. So for example, cash. The cash that is there with you is a current asset, right? It's a liquid asset, right? Debtors. Now debtors are people who you have made a sale to already but who have not given you the money back. So they are pending. So you know that I'm going to get this money, but you haven't yet received it. The third one that you see are stocks. By stocks, we're not talking about shares here, we're talking of inventory. So for example, if you are in the garment business and you say that I know that I'm going to sell 100 shirts this month, but I'm going to keep not 100 but 200 shirts. So that if by any chance there is some breakage in the delivery that I'm going to get, or just generally if there is a spike in sales, I'm going to ensure that I have supplies for not 1 month but 2 months. So that is a current asset that you create. The third one are deposits and advances, means if you have paid somebody a deposit. So if you have gone and if you have rented a place and they have said that, look, we also require a deposit from you for 4 months or 5 months. That is an asset that is created within the business. Okay. The converse of assets is liabilities. Now, instead of saying, so, liability in terms of a business or a balance sheet basically means where is it that the money is coming from. Okay. Now, in terms of this, also what you will see here is that in our long-term liabilities, we have actually put a shareholder equity. Now, to be able to understand how is shareholder equity a liability, I would want you to focus your attention on the term sources of funds. So like I just mentioned right now, a source of fund is of saying where is the money coming from into the business. And the basic premise is that at some time I will have to return it back. That is why it is called a liability. So for example, if there are 5 shareholders into the business, so they have put in the money, which is the source of fund, but at a later point of time, the business at some point has the liability to repay that money back to them. Right? That is why it is called a liability, and it is also a key source of fund. So long-term liability that you're looking at is one, equity that comes in. The second one is loans. So if you're going to a bank and you're asking for a loan, or if there are other investors in your firm that say that, look, I don't want to put equity, but I want to give you some loan that you want that I'll charge an interest on, or you yourself as the owner can say, I don't want to put all the money as an equity, some of it I can put as a loan, right? Now, if you look at the short-term liabilities are converse of what I had shown some time back, which is short-term assets or current assets. So creditors are when you have already purchased something from somebody. So your supplier, but you say that, look, I'm not going to pay you the money today, I'm going to pay you 30 days from now. Okay? So he becomes your creditor. If you know that you have to pay taxes at the end of the year, or you have not paid taxes this year, but so next year you'll say, oh, I might have a liability of a certain part of what I have not paid. So that is a tax. Provision, just to give you an example of provision, if you are, for example, in, if you're in the software business and you give warranty to people saying, if there is any damage or if your website is not working, I'm going to come and I'm going to take care of it free of charge. So that is the provision that you create within the business, saying I have to create a business for any warranty that I have given or any losses that I might incur over a period of time. So just to look at what we said on liability, just taking on from the first 2 points over there, saying equity and loan, those two together are what is called the capital. Okay. So what is the capital in a business? It is the cash or the good that is there to generate the income. It is what you put in the business to be able to get your revenue. And that capital comes in terms of the equity and the loan that is there. Okay. So capital in a business is created by cash, the equity that people put, and also the various assets that one creates to be able to run the business.